US stocks have had a great run, but some people question whether they've gone too far. A fund that excludes the US, or an ex-US fund, can help you do that very simply and cheaply. So in this video, we'll look at ex-US funds that are available, how to incorporate them into your portfolio, and some other ways to tilt away from the US. This video is sponsored by Trading212, a UK commission-free investment platform. Let's begin with why you'd want to tilt away from the United States in the first place. Well, there are 4 reasons, and I think the first one of those, which everyone's talking about, is that the US is a source of a lot of uncertainty at the moment. That comes in the form of political uncertainty, but if we look at something like this uncertainty index, you can see that for economic uncertainty, we're really off the charts right now. Now that makes it very difficult for business to invest, it may impact earnings in the future, and it may be that this ends the US's incredible stock market run. Another reason is that the US is very expensive relative to the rest of the world. Here I've shown you the cyclically adjusted price to earnings ratio, or CAPE ratio, from Robert Shiller. But if we looked at almost any other valuation measure, we'd see a similar picture. Whether that's forward price to earnings multiples, trailing price to earnings multiples, price to sales ratio, really whatever you choose to use as your valuation measure. And for non-US investors, another problem is that the dollar's been weakening quite markedly recently. Here you can see the trade-weighted US dollar in the top panel. Notice how after Liberation Day, there was a very marked weakness of the dollar, which hasn't really gone away. And what's even more remarkable is that that happens at the same time as we've seen US yields or interest rates remain high. Usually if US yields are high, that attracts money to the US and strengthens the dollar. So this is really very much, I think, based on that political uncertainty. The reason why this is a problem for non-US investors is that if you buy US assets and the US dollar weakens, well, that just reduces the value of your investment. And then finally, the thing that has lots of investors spooked is the amount of US debt. It seems as if US politicians of either party really are not that concerned about reducing debt to GDP. And yet their own Congressional Budget Office is telling them that they are on an unsustainable path. Here you can see the projections of US debt based on various scenarios, but you can see that the one big beautiful bill, which is about to be passed in the United States, could potentially push that US debt to GDP even higher. Why does that matter? Well, remember that the US's debt market is actually the largest in the world, and it underpins all assets globally. If yields in this market blow out, which is what could happen if the bond vigilantes take issue with this debt to GDP ratio, that'll cause a revaluation of equity all over the world, with the US being the epicenter of that crisis. So I think all 4 of these reasons play a part in why many people are thinking, maybe I don't want a huge US weight in my portfolio right now. And so that begs the question, how do you tilt away from the US in your portfolio? Now, before we look at some ex-US funds, I'd like to talk about Trading212's ISA, and today's video is sponsored by Trading212. I've been using their stocks and shares ISA for a few years, and I really love the platform, and this is why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I have on Trading212. They offer over 13,000 ETFs and stocks from the UK, US and Canada and Europe. And then finally, it leads the way with new functionality, and that's being released all the time. For example, it offers fractional shares, pies, auto-investment. My favorite feature would be pies, where you can create a portfolio within your ISA. In fact, I'll be talking about an ex-US tilted pie later in the video. Now, if I want to rebalance one of the pies, I can do it with just one click, and then you can fund your pie using regular investing via direct debit, and that does encourage a good habit, which is regular saving. You can also reinvest any dividends back into the pie, and that can also be used to rebalance it. And if you're scratching your head deciding what to include in your pie, there are lots of popular portfolios and even portfolios created by professional fund managers. Furthermore, Trading 212 charges no account fees whatsoever on their stocks and shares ISA. Their ISAs are flexible, which means that within a tax year, you can withdraw cash and put it back into the account without affecting your ISA allowance. Your money is kept in a segregated account and protected by the Financial Services Compensation Scheme up to a value of £85,000. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. Now let's take a look at some of those ex-US funds. Now, as far as I know, there are only 2 funds available to UK investors right now, which are explicitly ex-US. And both of them track the same index, which is the MSCI World ex-USA Index. MSCI is just an index provider, and MSCI World is a developed market index. So really what you're doing is you're taking the developed market and you're just carving out the United States and leaving the rest of developed markets in the index. So here you can see the fact sheet from MSCI for that index, and it's a great source of information. You can see the historic performance. It compares it with MSCI World, which is the developed market index. Notice the huge underperformance over the period that we're looking at here since May 2010, and that's because of the historic outperformance of the US over that period, which has been truly exceptional. So here are those 2 exchange-traded funds which track that index. One of them is from Xtrackers and the other one is from iShares. The iShares one hasn't been around that long, it's been issued quite recently. The Xtrackers one has been around for longer. And both of these are accumulation funds and they trade in sterling. So you don't have to worry about currency conversion fees on your platform. The fund manager does the currency conversion for you. Now, a handy tip is if you are looking at the fact sheet for your ETFs, it's always useful to find the version of the ETF which trades on the London Stock Exchange in sterling. Here I've shown how you can find that. For Xtrackers, it's under listing and trading information, and the ticker we want is XMWX. That's the one which trades in sterling. You can see that there is another version of the fund that trades in US dollars on the London Stock Exchange. And ironically, that has the much better ticker, which is XUS. I think XMWX is much less memorable. And then the iShares ETF has ticker XUSE. So what does the country composition look like for one of these ex-US developed market trackers? Well, you can see that here for the Xtrackers ETF. And surprise, surprise, the UK isn't such a tiny weighting in this index, which is nice to see. Japan's the largest allocation, that's 19%, the UK 13%, Canada 11%, France 10%, and so on. So not only does it exclude the US, which makes up 65% of global indices, but what's interesting is that amongst the other countries in the world, there isn't such a disproportionately high weighting for any other country. It seems to be better diversified. Now, it wouldn't make sense, I don't think, to tilt away from the US completely. So this isn't the whole story. You're going to need other funds to reconstitute the global index, which most of us have. And then what you'd probably do is just reduce your US weight slightly or not so slightly. Now you can do that very easily, very simply with 3 funds. You just need a US fund, a developed market ex-US fund, and an EM fund or emerging markets. If you want to reconstitute a global index, you'd use the weights of 65% for the US, 25% for developed ex-US, and then 10% for emerging markets. Those will vary over time, but they vary quite slowly usually. So let's say that you wanted to use those 3 funds to construct a tilt. Well, if you wanted to reduce the US by 10%, so instead of 65%, you'd have 55%. I've done that for you in this table, but it's pretty easy to do in an Excel spreadsheet. So the US would be 55%, developed ex-US would be 32%, about a third, and then EM would be 13%. If you tilt further, so 20% underweight for the United States, then developed ex-US becomes 39%, EM becomes 16%, and then I've also shown what would happen for a 30% tilt, which would be sizable. So bear in mind, this is not a recommendation. There's always a danger when you have a big tilt in your portfolio that it will underperform. Always consider the possibility that you may be wrong. You should think of these tilts a little bit like levels in Doom, where if you tilt too far, it's kind of like nightmare mode. You'll always be questioning whether you've done the right thing, and if you do underperform, you'll be nursing a lot of regret. Now, I've created a pie on Trading 212 to do that 3-fund decomposition of a global index. So this is the untilted version. You can see that because the US weight is 65%. Now, the overall fees for that pie are very cheap because if you look at the weighted expense ratio, it's only about 0.07%, largely because of the very cheap US tracker, which I've included here. Now, there are variations of this. You can use other funds for the other components. But if you are on Trading 212 and you wanted to look into this pie yourself, there will be a link to it in the description below. And now let me switch into my regulatory voice. This is not a recommendation. You should always do your own research. But seriously, you should. Now, there are other ways to tilt away from the US indirectly. Now, what I've done here is I've downloaded the country weights from the iShares tracker of MSCI All Country World Index. So this gives you an idea of global market cap weighting according to MSCI. Now, in theory, you could slice and dice this any way you like. You can make it as granular by tracking individual countries, or as we saw previously, you can break it down into regions, which means less funds to manage. So just as an example, I'm not saying you should do this, but if you wanted to make it a bit more granular, this is one way to do that. You could say have the United States. There are lots of trackers for the US. You could have a developed Asia Pacific or APAC fund. Perhaps you'd have a UK fund because that's where we live. Then you'd have Europe x UK and emerging markets. Now, these weights don't exactly add up to 100%. There's 9% missing from this decomposition. So in the bottom row, I've scaled things up so that it does add up to 100. Now, the beauty of this kind of decomposition is you can dial the weights down or up by region according to what you think the prospects are for that region. This used to be my job, in fact, when I was a strategist, but can I do it convincingly and can I do it consistently in order to outperform a global index fund? I don't think so. So this is why I don't use this approach. The more granular your decomposition of the global index, I think the less likely you are to outperform. Plus, it's just more work mentally, and I think I don't want to spend my time doing this kind of tweaking. So how else could you tilt away from the US? There are various factor funds that you can buy which would allow you to do this. For example, if you buy a global value fund, well, that's going to tilt away from the US because, as we saw, the US is currently very expensive. A variation of that idea is to go for a high income portfolio because the US is also quite stingy when it comes to dividend yields. Their focus is much more on capital growth. And of course, income is a variation of value. If you go for high dividends relative to the price, then effectively that's another value tilt. Another tilt might be small caps because the US is dominated by very large stocks. So if you go for a global small cap portfolio, at least it'll weed out those US mega caps, which are largely responsible for the US's expensiveness right now. And a variation of that is to go for equally weighted index funds where small caps have a much bigger representation relative to large caps and mega caps. But I'd be wary about tilting towards small caps because if there is a downturn in global markets, it's usually the small caps that suffer. Plus, this is a much more volatile way of investing. Small caps tend to have hugely fluctuating prices. And of course, that'll be reflected in the returns of the fund. And then finally, if you go for a low volatility portfolio, again, it'll probably tilt away from the US. And that's because it's a safety tilt and a tilt away from growth stocks, which tend to be more volatile. So any of these tilts would give you indirectly a lower US allocation, while still maintaining diversification. Now, it's always worthwhile thinking about the risks. And in the case of betting against the US, the risk is that you're wrong. It is quite likely that the US will continue to outperform. the reasons for its success, which is having these very successful companies which are very profitable, they have very high margins, and they generate a lot of profits which are growing rapidly. Is that about to end immediately? I don't think so. Is Europe going to storm ahead as it has so far in 2025? Will that continue? Perhaps. Or will emerging markets come to the fore as they did in the 1990s if we get a commodity supercycle or some other development story? Again, perhaps. But that's why I think it's always a good idea not to tilt too far. Don't go crazy with this. Don't exclude the US altogether. Just have a slight tilt in your portfolio. And hopefully this has shown you how to do that quite easily and quite simply and quite cheaply. Now don't forget our special offer from Trading 212, the sponsor of today's video, where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, use my name as the promo code, which is Ramin, R-A-M-I-N, and of course you'll find a link to that in the description below. And, as always, thank you for listening.